Gold on a fair value basis relative to financial assets is probably pushing near $10,000 an ounce. If you
Hmm.
take it to a huge, the radical overvalued on gold, you're probably looking at something close to, $15,000 an ounce. For right now, just don't worry about demand. Just put it out of your mind. There'll be hiccups, there'll be recessions between now and 2035. There's no two ways about it. There might even be a global financial crisis. Yeah, we're staying away from lithium, a structural deficit for the first time in the history of uranium. So, where do prices go from here? They obviously need to go to the level that will incentivize large scale new mines to come online. And we're getting kind of close, 100 to 125 bucks, I think is probably my estimate for where the market would clear over time, long term. We have some exposure to both thermal and met coal. I think both will do well. The risk near term to copper demand is not economic slowdown, but rather the bloom coming off the rose on some of these renewables. And by the way, right now we are as cheap as we have ever been.
Right, Adam, been about a year or so since you and I last sat down for a conversation. A lot has happened in the meantime. I was looking at some of the other interviews, and I could see that Lee's paper pile in the background there had grown quite a lot as well. And I'm curious about the correlation between that and your guys' portfolio. And specifically because last time we spoke, you told me that you had 42% in oil and gas, you had 16% in uranium, and you also said that you were adding to your positions on gold and your positions on copper. How's that breakdown changed over the last 12 months, and what does it look like right now?
Well, I think for the most part, most of the changes until recently have been market driven more than anything else. And so, there hasn't been a huge shift in our top down sector allocation. The exception to that, I would say, would be gold recently. I think that the breakout in gold to a new all-time high in the last couple of weeks has been fairly decisive, and I think that we're starting to see the next leg in the gold bull market. Now, what's interesting about that is that the gold shares haven't taken the same path, and they're still trending kind of flat to down, and so I think that creates a really good opportunity, and we can talk all about that. So I think that that's been kind of the big change in recent months, has been that we've taken our gold allocation up by several hundred basis points. Again, probably shy of a full position. We're trying to leg into things, as we've talked about in the past, and as some of our people and our followers know. We tend to be pretty good on the research side of things. We tend to be pretty good in expressing those, but we're very poor market timers. And so I can't tell you if it's this week or this month, but I think we're getting awfully close to a very strong, robust catch-up trade in the gold stocks. And so we've been adding to some of those over the last couple of months.
What would a full position look like? What in terms of percentages?
So typically for us, we start everything from our research, and we publish our research widely. We put it all on our website, and we speak on podcasts about it and stuff like that. And I always think it's kind of humorous when people will reach out and ask if they can bargain down the price of our research. And I say, guys, our research is free. And so, I'm not going to pay you to read it. So I don't think we can go much lower than free. But really, that forms the basis of our investment process. And we've always been investment managers first and foremost. The research is really a way for us to hone our thoughts. It's a way for us to keep us on a schedule, on track, honest a little bit, be able to say, okay, how do our views change? It's one thing, even good investors can delude themselves into thinking they called everything right. But I think when you are forced to put it down on paper and keep a paper trail, that makes you stay intellectually honest and understand where your shortcomings are, what you got right, what you got wrong, and how to amend your models going forward. So our research is the basis of everything that we do. And from that, we look for areas of the market that are completely unloved, that are completely out of favor, where there's no investor interest. The price is unsustainably low, and obviously unsustainably low is a little bit subjective. You can only know it in hindsight. But for us, unsustainably low means that the price of the commodity isn't high enough to incentivize enough reinvestment in that industry to keep it afloat. And, uranium was a great example. When uranium hit 18 bucks, Cameco and Kazatomprom had a cash cost of like 25. And so that's unsustainable. Certainly you can't incentivize reinvestment. You can't even, frankly, make a cash profit on your existing operations. Now, they did because they had these long-term contracts at higher prices, but nevertheless, they ended up shutting down some of their big key mines and bought in the spot market. That's unsustainably low for us. So that's what we like to find are those sectors. And then we set a portfolio weight that can express that. And so a typical sector weight for us would be between 20 and 25% of the portfolio. And the reason I say that is 20 is kind of the target, and then we let things run. We're not so quantitatively driven that we're rebalancing everything every day. If something's working, we want to give it a little room to run. And so we'll let it grow to about 25% of the portfolio. So, that's where a full weight for us is, call it in that 20 to 25% range. Gold might be a little bit lower than that. We actually, it's kind of funny. When I was in my 20s, I took the CFA, and the CFA, knocks you over the head with all this quantitative finance, and it tells you that, there's no room for value investing. It's all about, running these big quantitative models, and that's not entirely true, but that does seem to be the thrust of it. And I remember following that, we actually computed a big black Litterman model, which is a optimization technique for portfolio management, where you can actually take into account a portfolio manager's views and his degree of confidence in those views, or an outside manager's degree of confidence in the PM's views. And what we actually found kind of interesting is that based on the level of conviction that we have, and based on how often we get things right, and a lot of assumptions in there, and the covariances of the different commodity sectors, about 20 to 25% is a pretty optimal weight. It'll obviously tell you a little bit higher here, a little bit lower there, but as a rule of thumb, we were happy. And to be clear, we don't manage the portfolio based on those tools, but we were happy that the mathematics sort of backed up our intuition, which was that 20 to 25% when you have a really key high conviction view in our sector anyway, is pretty appropriate given the risks that it entails. Now, gold's a little bit different because gold, has different correlations. For instance, oil and natural gas have a certain correlation, and even copper and the other base metals, even those to energy has a certain correlation. And gold kind of exists a little bit on the outside of that correlation metric. So you might argue that maybe it's a couple 100 basis points shy of 20% would be a full weight. I don't know. We'll have to wait and see where we feel.
Okay. I do want to talk about gold, and specifically about gold equities that you called possibly the most undervalued asset class in the world in your last investor letter that you wrote. That's, by the way, for people listening, GoRozen.com is where you can find those. It's free, as Adam mentioned here. The portfolio was worth about $400 million back then when we last spoke. What's the state of the overall AUM right now?
We're pushing 600 million now, so we've had some nice inflows. I can't remember exactly when we spoke, but it would have been either right at the beginning of or slightly before we launched a UCITS fund. And so now we have a UCITS fund for international distribution, and that's helped to drive some nice growth and allow us to access and provide solutions to some clients that otherwise would have been challenged with only a US vehicle before that.
Nice. Yeah, I think it was the beginning of April.
So I think we
Mid-April.
we launched it May 15th of last year, and we've
Okay,
seen
cool.
actually really good support. And that's actually quite important, I think, from a sentiment perspective, because very clearly a big impediment to asset allocators looking to the resources space has been that the ESG movement has made a lot of these stocks, quote unquote, toxic. And Europe certainly led the charge in terms of the ESG
Mm.
push. And so the fact that we've actually seen some keen interest throughout Europe and in Switzerland and in the UK as well, and in Germany too, it's either a sign of one of two things. It's either a sign of a group of people that used to like our research and didn't have a good way to do it and pent up demand, or it's a sign of times that are a little bit changing. I obviously hope it's the latter, but that remains to be seen.
I agree. I have been relatively active over the recent past too, going to many conferences, London, Frankfurt, Zurich as well as over the pond. And I can see the sentiment changing towards how we think energy. And I mean, when I say we, I mean Europeans. This is actually a good segue into that newsletter that you wrote. The market commentary was kind of focused on Norway there at the beginning for a moment there. But so that sort of made me assume that you still have no lithium or battery metals exposure. Is that right?
That's correct. Yep, we have no. I mean, we have a tiny stub in some nickel production,
Mm.
but we don't have any lithium, and I don't think, certainly for the foreseeable future, unless something were to dramatically change, I don't see that view changing. And the problem with lithium is really twofold. First of all, as we outlined in that letter, and for those we can that didn't read it, we can talk about that in depth. But it talked about a lot of the challenges of EVs in terms of meeting a lot of misconceptions of EVs and a lot of challenges of EVs in terms of meeting the CO2 reduction goals that they claim to. And Norway is a wonderful or terrible case study, depending on which side you want to take on that, of just how difficult it really is to get big penetration that makes a difference. And we're happy to talk all about that. But so I think that the demand outlook for EVs will be driven more by government policies than by consumer demand and appetite, because very clearly, in our mind anyway, EVs are not the most energy efficient way of moving people around. And so it's very hard to stuff a less efficient technology down people's throats when it comes to a prime mover, as they would say, for the automobile. And so I think that's going to be just a big headwind. So I think on the demand side, there's disappointments ahead for EVs. And on the supply side, lithium is not a particularly rare mineral. Really, the bottleneck to large scale lithium production is capital. And that's true in all commodities to some extent, right? I mean, we've seen huge commodity booms that lead to massive overinvestment, which then depress price for a long period of time. And even relatively scarce minerals like copper can get ahead of themselves and have too much capital put into the sector and see prices collapse. And indeed, that's the opportunity and the curse of the commodity markets. They're highly cyclical because from the moment the market signals it needs more supply to when that new supply comes on takes time. And in that time, prices rise, profits soar, and then investor capital just floods in. And inevitably it overshoots the mark because there's no, grand capex czar that says, okay, enough's enough. We're going to cut it off now. So that's true of all commodities. It's certainly true of lithium, where there's not a particular resource scarcity. There's relative abundance. And so the question you have to ask yourself when you're looking at the attractiveness of lithium is whether or not there's been a dearth of capital or an abundance of capital. And very clearly in our mind, there's been a huge abundance of capital investment in the lithium space. It seems as though almost every day there's been a lithium offering over the last couple of years. There's companies that don't even produce lithium as their main source of revenue that kind of rebrand as lithium companies, the same way we saw that in the rare earths or AI or whatever the investment fad is of the day. And so I think with all that capital coming into this space, you're bound to have an oversupplied situation, and made worse by the fact that the demand estimates are probably too high. So yeah, we're staying away from lithium. Look, lithium stocks are volatile. They've pulled back, and again, we're not big traders. Could they be worth a buy for a pop? I have no idea. You can talk to somebody more adept at that type of an analysis than I am. But in the long run, there's just way too much money chasing lithium. It's not overly scarce, which means that production will come on, and demand is probably overstated.
I actually did talk to someone. It was last week in at one of those conferences that I'm mentioning in Switzerland, and they told me it was something. The guy said it as a joke, but it was kind of telling of the market as well. He said the guys in South America produce lithium at a negative cash cost. Um, saying that it's very cheap to produce lithium. So once you have a sustained price move for a couple of months, that production jumps on relatively quickly. Very much unlike what uranium can do, for example, with the sulfuric acid shortages and stuff like that. Also something we can talk about. But I'm reminded and the reason why I really brought it up is, well, first of all, to gauge your portfolio, but also because I wanted to talk or segue into copper, because it seems like the whole green revolution thing hitting what we call a speed bump might have also changed your perspective on copper demand, or hasn't it?
Well, so it's interesting. When it comes to copper and copper demand, And we first wrote this, gosh, a long time ago. In fact, I think that we were one of the first, if not the first, people to say that copper was the quintessential green metal, and if that you wanted an energy transition, you were going to have a hell of a lot more copper than you have today. Um, the reason I'm fairly certain we were at least amongst the first to say that is that, the amount of pushback we had on that, people saying, oh, you're just trying to greenwash your dirty mining portfolio and stuff like that. We said, no, look, there's no way around it. The idea that a central natural gas turbine with one centralized source of power generation requires substantially less copper than having a distributed field of hundreds or thousands of PV solar panels or hundreds of windmills, each with an interconnect and a tieback into the main facility. I mean, the numbers are staggering. So, however, there's several other sources of copper demand growth that are really important. And for us, what was really interesting about the copper thesis, and again, this is going back now to probably 2016 and 2017, was that there were two main conventional sources of copper demand that allowed you to quote unquote win. And then there was this whole green revolution. And so for us, when we were looking at various investment opportunities, it's like you got a free call option on renewables. And a free call option, I'll take a free call option. I mean, I don't think renewables make any sense. I don't think that they have the energetic efficiency or the thermodynamic efficiency. We could talk about what I mean by that, to displace fossil fuels. I think nuclear is super efficient and low CO2. That's why we should be going towards that. But I think that given a choice between more efficient in terms of energy return on investment or less efficient, society has never once chosen less efficient. And I don't think that CO2 is going to change that. So I think we need to find solutions that are as or better in terms of efficiency, as good or better, with less CO2, and that renewables don't fit the bill. However, if someone wants to give me a free call option on renewables, I'm not so hubris filled that I'll say I won't take that. And that's what copper represented. Incidentally, we actually did make a lithium investment once in the past, and it was actually quite successful. But again, it was a free call option. We used to own SQM, which was a fertilizer company that had big lithium assets in South America. And when you looked at it back when we made that investment in 2016, I believe, it was trading completely in line with the other fertilizer producers on a phosphate basis and ascribed zero value to the lithium. And so we figured, okay, well, look, if I'm going to own Mosaic or if I'm going to go own SQM, I might as well own some SQM. I'll get a free call option on lithium. Now, all of a sudden, a couple months or years later, that hit. The call option went severely in the money, and it became a lithium producer with a call option on fertilizers, and that wasn't of any interest to us. So we exited that position a long time ago. So, free call option, I'll always take that. But the two sources of copper demand that I think are really interesting, apart from the renewable side, which really kind of formed the foundation of our bullish thesis on copper, apart from supply, is China, which people kind of say, what do you mean China? China's been the copper demand story for 15 years, and now we have this huge property bubble, and we're going to see a massive, massive implosion in their building sector and potentially even their economy. And how can copper do well there? And the answer there is fascinating, and I think a lot of people get it wrong. The idea is that today China consumes well over 50% of the world's annual copper demand. However, they're not 50% of the world's economy by a long shot. Obviously they're not as big as the United States, and there are other countries besides China and the United States. So well short of 50%. So people have said, well, clearly China's over consuming copper, but we did a study and we said, well, wait a sec. I don't think you're looking at that right. When you look at oil, it stands to reason that countries that are bigger will consume more oil. And there's probably a tight relationship between GDP and oil consumption, because ultimately energy is the bedrock for everything in the economy. You can't really do much in an economy without converting energy from one form to another. That's kind of what life and society is all about. Grains are the same, you consume them, they're gone. Copper is not really like that, though, nor is steel, because you don't really consume it. You can't see it anymore, but it remains installed in an economy as part of the infrastructure, as part of the building stock, as part of the electricity grid, and things like that. And so instead of being consumption that we need to look at, we should probably look at total installed copper in an economy. And you need to make some adjustments for depreciation and things like that, but you can get a pretty good stab at what the total accumulated copper in an economy is versus how big the economy is per capita. And what we notice remarkably is that there's a very consistent trend over time. In fact, more consistent, in some ways, even more consistent than energy. You simply cannot have a large middle income economy without a certain amount of copper installed per person for things like electricity generation and distribution. That's the main one.
Mm.
So where's China now? Where should it be? It's exactly where it should be for an economy of its size. And if it ever wants to get, it's at about $12,000 of per capita GDP today. If it ever wants to get to the low end of a wealthy country, out of the middle income trap that they talk about so much, it's going to have to substantially increase its installed copper. So will copper demand grow in China from here? It's an open question. I think it probably will, but I don't think it can fall, because if you want to get from 12 to 20,000 in the next 20 years, you're going to need to install a quantum of copper in that economy. And if you divide it by the number of years, that's basically going to be near where we are today, if not slightly higher. So Chinese copper demand, I don't think, is at risk of slowing. In fact, I think it's probably going to grow from here. But then India has now come, and we first identified this also back in 2018, and India has come almost out of nowhere to become a huge, huge line item in year-on-year copper demand growth. And we made that prediction after having visited India. Lee's been several times, I've been once. And what we noticed was two things. First of all, India in 2018 was exactly where China was in 2003, which of course that was the right before their demand started to grow sharply. But second of all, India was well below its trend line, meaning it was underinstalled. So there's going to be a catch-up trade that needed to happen, and then it was going to need to move along its development timeline. And based on those, we said that China, that India could start to see, several 100,000 pounds year on year of copper demand growth, huge numbers. And that's in fact exactly what we're now seeing. So believe it or not, in 2023, Indian copper demand was up 40% over the year before. I mean, massive. And you're starting to finally see that economy really awaken to its dearth of copper that's been installed. It shows up in things like rolling brownouts and blackouts throughout India. People talk about this major disconnect between power generation, where they have too much, and then availability of electricity to residences and industries. The problem is the distribution, and the distribution is what's copper laden. And so that's where we're going to start to see huge increases in copper demand. The other place is now in Indonesia, which, most people, I think some people can find it on a map. Most people underestimate how big of a country it is, over 300 million people. And they're now in the process of going through their big copper ramp. And so we've seen, don't hold me to the numbers, but maybe 20% year-on-year increases there, and quickly out of nowhere became the top 5 line items of year-on-year growth. So we're seeing lots of conventional copper demand growth coming from emerging markets that continue to urbanize and continue to develop. And I know that sounds like it's a story that's long in the tooth, but maybe it is, maybe it's not. When I look at the numbers, though, you can't run an economy that's bigger than the ones they have. The bottleneck is the copper. It's not the bottleneck, but you can't grow the economy without growing the copper. And so I think we're going to continue to see that. So I do think that the risk near term to copper demand is not economic slowdown, but rather the bloom coming off the rose on some of these renewables. But you don't really need that for the trade to work. Now, will that, make the stock sell off? Yeah, I think frankly that's what we saw in the back half of 2023 when copper stocks were quite weak. I think what we were basically seeing was people beginning to question the renewable thesis, and some of those stocks trading kind of in line with the directionally in line with the renewable energy companies. So I think that's probably behind us. I think the market remains extremely robust here going forward. The numbers that keep coming in are really, really strong. Supply has been more challenged than most people expected. Chile has all these outages. Cobre Panama now in Panama looks like it's going to be certainly shut down for some time and have an impact on copper markets. And those are big numbers. So it takes a while for new copper mine to come online, and I don't see anything in the near term that's really going to loosen things too much there.
I do want to talk about supply because there's some interesting stuff that you wrote about that as well. Um, emerging markets though can get messy, right? Both to the upside and to the downside, as sort of shown by India's previously desired but unmet infrastructure goals. Is there a way to account for that in your approach or methodology?
Not particularly. I mean, emerging markets certainly. I don't know. Sometimes living in the developed world, I'm not entirely sure whether we have it so much better or more stable or more sensible. But yeah, look, emerging markets carry their own risks, but ultimately, I think what we've seen time and time again is that as countries develop, they start demanding different things. They start requiring more energy. They actually begin to switch their energy mix quite sharply. They want to improve their environment. We used to say that when a country gets richer, it starts to want cleaner air. I don't know that that's true. I think they probably always want cleaner air. They just can't afford cleaner air. And so as a country gets richer, it begins to be able to afford cleaner air, and it switches from coal to natural gas and things like that. It has nothing to do with carbon emissions. There's no developing country in the world that really cares about carbon emissions. What they care about is particulate matter in the air and stuff that they breathe, and the fact that you can't, for a long time, couldn't see the sun in Beijing or Shanghai. And as you get richer, you start to demand more from that. You then require more copper in order to handle all that energy, and things begin to move from there. So are there setbacks? For sure. Are there legislative roadblocks in India? Is there, potential stagnation and things like that? Of course, it always happens. India is not China. It's not a command economy. It's a, very, very, very bureaucratic democracy. And so there'll be things that come and go, but the trend is certainly up and to the right. And for that, I think all you have to do is look at, over time, if you think about resource consumption really broadly, this is mostly energy, but you can apply variations of it to the different sectors. Countries starts out, it's poor on a per capita GDP basis, and it consumes very little. And so what's the relationship between resource demand and GDP growth? I mean, I'm sure it's there, but honestly, the numbers are so small that no one really cares. Then all of a sudden it begins to develop and it starts to consume more and more and more. And at a certain point, it levels off. Because you kind of saturate, I think most of the developed worlds right now, our energy demand goes up every year, but the energy efficiency of unit of GDP gets better. And it's not because we use more efficient sources. It's because, we're less industrial and we're more service based and things like that, so we're switching. So you see that pretty consistently over time. You start out really low and some growth, but who cares? Then you have this period of robust growth, and then it tapers off a little bit, and you still get growth, but the slope is less. And it kind of traces out an S. If you look at resource demand per capita on the y-axis and GDP on the x-axis, it traces out an S, and we call that the S curve. And the sweet spot is between about $5,000 and $20,000 of per capita GDP. That's where most of your demand growth really comes up. And we can go back, and that's real per capita GDP, so we can compare it across time periods. And we can go back to the early 1900s and begin to say, okay, at what point did we have big groups of people go through this development? And so what's interesting is that number is like kind of pretty consistent, kind of remarkably so. About 300 to 400 million people would go through the S curve at any one time. And, maybe France would enter it, and then it would fall off. And after World War II, Japan entered it as they rebuilt. And then Japan kind of phased out. They became rich, and Korea entered it in the 1990s. And then it fell out in the late 90s, early 2000s. And so you have all these countries that trace out their S curves. But in aggregate on planet Earth, you had about 400 million people going through it. And now we have upwards of 3 billion, 4 billion, depending on how you count it. You have China, you have India, you have Indonesia, you have Philippines, Vietnam, Thailand, Malaysia. And we've never been there before, right? It's never been like that. And I should point out, just so people don't think, we're total perma bulls, it'll never be like that again. After this group cohort goes through, we don't have enough people on Earth to go through that really intense period of their S curve. I wouldn't be surprised, just knowing how cruel markets can be, that if we don't end the 2020s and go into the mid 2030s with commodity prices super high because we've underinvested for so long, with potentially a new financial monetary regime in place, and hopefully not, but looking more and more likely like a big armed conflict somewhere on Earth, that right at that time, when everyone becomes super convinced that all they need to own are resources, we're going to move that huge block of people through the S curve, and we'll then we'll have set up an industry that will never have that level of demand again, and will be chronically oversupplied for a generation. I don't know. That's a problem to worry about in the late 2030s, but I would suspect that would be the case. But my point being is that for right now, just don't worry about demand. Just put it out of your mind. There'll be hiccups, there'll be recessions between now and 2035. There's no two ways about it. There might even be a global financial crisis. But you know what? In the last global financial crisis, we rebounded energy demand within 18 months. We made the old high. It came roaring back. And after COVID, there was a huge view also that, 2019 in retrospect would have been the year of peak oil demand and peak energy demand and all these huge views, because now everyone was going to work from home and not commute. We made a new high in global oil demand in 2022, the first year that lockdowns, were completely removed. Not even, in some cases they weren't. Air travel wasn't back to normal. So demand came roaring back in 2008. It came roaring back in 2022, 2021, 2022. And I think that's going to be the message between now and when this huge 4 billion person cohort makes its way through its S curve tipping point. It's like, just don't worry about it. I know that sounds flippant, and I know that sounds counterintuitive, but I think people that are fixated on potential China economic squishiness in 2024 and are not investing in the right energy infrastructure and copper supplies, I really think they're missing the thread, or they've lost the thread. And I think that it's going to be to their detriment.
You're making me think that I should start thinking about a different name for this channel in 15 years. Instead of Resource Talks, I have to call it something else Talks, because resources might have had their time in the sun. If I play my cards right, I wouldn't even have to make YouTube videos for a living anymore. Can you imagine that? But so the point is that I think a lot of what you're saying, it aligns well with what Alex Epstein has been writing in terms of, sure, people in developed countries want clean air, but they want food, energy, and shelter way more than they want, clean air. And they don't have those first three things to begin with to start wanting the fourth, basically. So that's what it comes down to. It's also a big part of the oil thesis, right?
Oh, absolutely. Look, there are certain undeniable human desires and trends that take place. And I think that, when you read works by, whether it's Vaclav Smil or Charles Hall or Mark Mills, or, go down the list of energy writers, or Richard Rhodes wrote a really interesting history of energy as well. It's so clear that ambitious, industrious spirit that's in all of us leads to more and more and more and more and more energy demand. And that might be a good segue into this essay that we wrote about Jevons paradox. And that's a really fascinating thing, but I think it captures it so well. Okay. And it goes basically like this, in the 18th century, I believe, or 19th or early 19th century, Jevons, who is a economist, began noticing a really strange, what he called a paradox. And basically what had happened was that, go all the way back, England burned firewood for its energy and charcoaling purposes and building materials for a long time. And then it basically clear cut most of its old growth deep forests. And the amount of energy contained in a tree was less than the energy needed to bring the tree from the hinterlands back into London or whatever. And so that became a net energy sink, and it stopped. And they started burning coal. And when they started burning coal, they said, wow, this is super efficient. Who knew this? We'd heard stories that this black rubbly rock burns in the right conditions. Sure enough, it does, releases energy. And then they started building the steam engine, and the Industrial Revolution was born. However, after a couple decades, there was a huge concern that the English coal seams were beginning to deplete. And there's all this really interesting, early work done in the commodities trades on depletion and things like that. And it all centers around the English coal reserves. And as a result of that, the main consumer of coal was for the steam engine. And the steam engine was terribly inefficient. It was like 9% efficient, or maybe even less than that. And so there was a view that if we can increase the efficiency of the steam engine, then all of a sudden that finite resource or reserve of coal that we have will go much farther and last much longer, because it'll require less coal to do the job, right? And so it's as though we tripled or quadrupled or quintupled the coal reserve that we have at hand. And so lots of work was done by the engineers. And in fact, they massively, massively increased the power of this, or the efficiency of the steam engine. And there's, again, wonderful books written in all those books that I referenced, chapters written about the advancements of the technology of the steam engine and the ability to not waste so much of the coal's energy, but actually convert it into useful motion. And what did it do to the coal reserves? It massively increased coal demand, and it accelerated the depletion of the English coal seams. And that's what Jevon called his paradox, is that all things being equal, if you increase or improve the efficiency, energy efficiency, you'll consume more energy, not less energy. And I think that really kind of sits at the center of a lot of these questions that we have today, right? Because the idea here is that we're constantly wanting more. We're constantly wanting to build. We're constantly wanting to urbanize, develop, increase our lifespans, provide more food, prevent, childhood malnourishment and childhood mortality. All these things that, frankly, are as universal as you'll find anything to be, amongst all of our differences and things like that. And all of that requires more energy and more efficient use of energy. And the more efficient you make something, it doesn't decrease the aggregate demand. What it does is it shifts the cost curve down and actually results in an equilibrium where we consume more. And I'm not sure why, it's like microeconomics 101 versus, policy making. I'm not sure why people fail to see that. So yeah, you want first your shelter, you want food, and then you start to go down your pyramids of wants and needs or whatever, and eventually you have culture and art and all this type of stuff. But we're not going to consume less of this stuff. It's just not possible.
You bring up a very good point when you talk about pyramids, because you're reminding me of Maslow's hierarchy of needs, right? Where it sort of starts with physiological needs, safety needs. A lot of these basic levels of the pyramid have not been met for billions of people out there, and they are going to be met for them over the next, decade or maybe couple of decades, and that's all reliant on more energy. More copper for now, because we just don't necessarily have another substitute for it unless copper becomes as expensive as silver, I suppose. But I do see that point. You bring up coal, which is also interesting to me. Um, and I know you do a lot of these conversations. There definitely is no shortages of podcasts these days. There's a little bit of an oversupply, actually. I'm not very bullish on podcasts, but you rarely get asked about your exposure to thermal coal versus met coal, because there is a difference there that I understand only basically, but I don't necessarily understand it within the investment realm. Do you make a difference between those as far as investments go?
Look, I do think you do have to make a distinction there. There's clearly some connection between the two coals, and I'll talk about what that is. Some of those trends and connections got thrown out the window last year. We have some exposure to both thermal and met coal. I think both will do well in the upcoming rally, but no, there is a huge difference, and I'll kind of go over it rather quickly. The so in some senses, all coals are the same. They represent organic matter that's been compressed to a certain point where you've begun to go through the thermal cracking process. So it's no longer peat, it's no longer, actual leaves or organic matter or animal matter or whatever, but it's not yet to the point where it's oil or natural gas, which is what you would get if you continued to compress an organic matter under temperature and pressure for hundreds and millions of billions of years. So the step before that is coal, and coal is basically, just a straight hydrocarbon, but there are some impurities and there are some differences in the various coals that you get. And because of those impurities and because of those differences, they'll all burn, they'll all combust, they'll all release energy. But what's special about the metallurgical coal is that when you effectively combusted in the absence of oxygen to make coke, which is an intermediate step product, what you'll end up with is a material that has the right permeability and porosity to allow air to flow through it. And it will be very, very, very resistant to crushing, which means you could then, on top of that coke, which used to be the special type of coal, met coal, what they call, metallurgical coal, you can pile a tremendous amount of iron ore on top of that and combust the whole thing and take that iron ore, which is iron and oxygen, heat up the iron ore so that the iron and the oxygen bonds break and you have just pure iron and pure oxygen, and then attract the oxygen to a carbon molecule from the coal or from the coke to create CO2, unfortunately, and the pure iron, which is then made into steel. So if you just used a regular coal, you could theoretically make some amount of steel using a regular coal. The problem would be you wouldn't have that same structural integrity because of the impurities. So you wouldn't have the same structural integrity in the coke. And then when you started to pour the iron ore on top, at a certain point, it would collapse and crush, and you wouldn't be able to get the fire going. So with the coking coal or the metallurgical coal, it has special properties, special purity, level of purity, relatively high energy content, per kilogram, and a right chemical composition that you can make good quality coke from it, and then pile a huge amount of iron ore on top in a blast furnace, and then get to work making steel. So in theory, met coal is a subset of thermal coal and should always trade at a premium price, because if push came to shove, if we turned off all the steel mills in the world, you could easily take all that met coal and throw it in the boilers and furnaces that use thermal coal to make electricity. The problem, though, is that we've become so precise over the years that a lot of these power stations that burn thermal coal expect a really certain type of thermal coal. And they've been completely tweaked and tuned to operate at peak efficiency using a specific type of coal with all the various impurities and whatever. And so if you then throw in a higher grade coal, like a metallurgical coal, which again is a subset of all the coals, you might actually potentially even reduce the efficiency of that plant because it's not tuned to that higher grade coal. And so we ended up last year in a situation which was really bizarre, which we had never seen before, where we actually got thermal prices above metallurgical prices, which in theory should not happen, right? Because you can substitute met for thermal, but not thermal for met. So met should set the high price, and at the very worst be equal to the thermal prices. And we didn't have that. That represented a near-term supply-demand dislocation. We don't have that to the same extent anymore. So I think both will do well. They obviously have completely different end markets. One is for making steel, one's for making electricity, but both share the similarity that we have underinvested in the industry for 10, 15 years. I mean, the coal markets have been completely shut off. You couldn't do a coal deal. If you went to a big integrated mining company and asked to buy their coal assets and agreed to pay their environmental remediation liabilities, they'd give them to you. We've seen that. So there's just there's no market for these assets, and that's what's going to drive the bull market.
So in your own portfolio, though, would you get more exposure to met coal or to like how do you even do it when it comes down to buying equities within this space? Yeah, go ahead.
Yeah, you have to look at the companies and the deposits that they have. We have some exposure to met and some exposure to thermal. We're not looking to make a huge call between the two.
Okay. Fair enough. Definitely way out of my depth here, as it is with most topics. But I appreciate your overview of it. I haven't asked you about uranium yet because it's sort of an outlier within its own little world, if you will. A lot of what we've been talking so far has a lot to do with Maslow's hierarchy that we talked about, and also just the S curve that you mentioned. Um, Uranium, not so much. I mean, it almost seems like it goes up no matter what, or at least that's what I'd like to believe or make my wife believe. But we're no longer where we were 12 months ago when you and I spoke in terms of uranium. Although I know that you're still very much bullish on it, but has your approach changed based on what's been happening?
Well, not really, because when you look, so first of all, what has happened in the last 12 months and where do we see things going? And then how do we react and how do we trade that? Ultimately, people are getting really excited about this new nuclear renaissance and small modular reactors and stuff like that. But that's out a few years. What we have right now is we have a problem. We have, for the first time in the history of nuclear power, based on today's reactors, we have now a situation where we have a structural deficit. Now, why do I say that's the first time in the history of uranium and stuff like that? Well, because since Oppenheimer uh, conducted the Manhattan Project, which we're now all very familiar with, although in that movie we do know that Oppenheimer did not split the atom; that was done before, but not by long. But from that day forward, we've always carried inventories. At first, they were military inventories, then government inventories more broadly, trying to keep material away from perceived enemies. Then what happened in the mid 1980s was Russia was Soviet Union was in a tough spot financially. They had all these, not only active nuclear weapons, but they had a huge stockpile of uranium to be able to make more. And they said, look, we have enough weapons to destroy each other 100 times over. We also are, quite short of money. So how about we reclassify some of these government stockpiles as commercial stockpiles, and we can sell them into the reactor market? And so the U.S. and the Soviets agreed to do that. It was called megatons for megawatts. It collapsed the uranium price, right? Because all of a sudden you had this huge source of supply flood the market. The U.S. went from being the largest uranium producer in the world to producing nothing. And you saw, a huge reduction in mine supply over the next several years. And from, the mid 1980s all the way to about 2003, 2004, we dwindled that stockpile lower and lower and lower.
Mhm.
And so mine supply wasn't enough to meet reactor demand, and the difference was all met by these government stockpiles. So my partner Lee first got bullish of uranium around that time, when you on the back of a napkin could say, well, I think we're going to run out of this stuff pretty soon. And sure enough, that's what happened. And prices went from $9 to $150 pretty quickly. The GFC happened, prices pulled back, then they started to rebound and they were moving higher again. And then all of a sudden, Fukushima happened and all bets were off. Uranium prices collapsed and spent the next 10 years in a bear market. We shut off 30% of the global reactor demand. Making matters worse, we also brought on a lot of new supply because in the last bull market, again, signals, they're not synchronous. So in the last bull market, prices ran. All of a sudden, companies started to invest in new uranium mines. That happened clearly in Kazakhstan, which became a major player, the world's largest uranium producer, before they produced almost nothing. And so you had this really oversupplied market. And that's now changed. In 2018, we went from reactor demand exceeding mine supply, the difference being made by that Fukushima commercial inventory that was accumulated after we shut all the reactors in 2011, 2012. And from 2018 to 2022, 2023, we dwindled down the commercial inventories until the point where now we have none left. So we don't have the government inventories. We don't have the commercial inventories. Mine supply is falling short of reactor demand by 20 million pounds. These are big, big numbers, and they're a deficit, a structural deficit for the first time in the history of uranium. So where do prices go from here? They obviously need to go to the level that will incentivize large scale new mines to come online. And we're getting kind of close, 100 to 125 bucks, I think is probably my estimate for where the market would clear over time, long term. So you got close to that, and then you pulled back, and now you're moving up again steadily. But you can't turn a uranium mine on overnight. There's a ton of permitting, a lot of mill requirements, a lot of upgrading and things of that nature. So I think we're going to overshoot the mark to the upside. I don't think that demand destruction will play a big role in the uranium market. And the reason I say that is that the total cost of uranium to a nuclear reactor is quite small. Once it's up and running, you got to keep it fed. So to me, this bull market ends when lots of new supply comes online, right? Psychologically, it'll be some big announcement along those lines. And I think you have room between now and then. So no, you're not as depressed as you were a year ago. You're certainly not as depressed as you were 2 years ago. But you have a clearer line of sight to how this is now going to play out. I think that you got some hot money, some hedge funds that were playing in the uranium stocks last year for sure. They've worked their way out. Now you're going to consolidate before you have another leg higher.
I'm thinking about how the uranium investment story concludes though, and maybe also when, because so you mentioned it concludes when a lot of new supply comes online, but we have over as you wrote, over 50 financial buyers now being thought to have bought and stored physical uranium. A lot of them, unlike spot, will be selling here and there. Some of them are maybe happy with 90, some of them might be happy with 80 if they bought it on time. So how does this investment eventually come to a conclusion for you guys, given the size of the position where, again, last year was 12% of 400 million bucks. This year it's 600 million bucks. So it's, and if you kept it at 12% or more, it's still, I mean, it's a big position. So how
Yeah.
do you eventually exit that position yourself?
Well, look, again, we try to be contrarian investors, so I hope we're going to exit the position, in a flurry of bullish optimism, and we'll get it all done in one afternoon, probably, or would be able to. Ultimately, I think you have to kind of divorce the psychology sometimes from the fundamentals. I think the fundamentals, what we like to look at is we say, okay, look, will it be demand or will it be supply that's going to undo this or this bull market? And I think in this case, it'll be supply. I don't think it's going to be demand. So then you'd have to turn to the market psychology and say, okay, fine. Well, given the supply demand dynamics, and I know that I'm going to look towards supply to be the off ramp for where this bull market ends. What's the market underwriting and what's the market, implying in terms of its valuation and in terms of its prices. And I think when I look at that, we still, we started to see some speculative interest, and that had a positive effect on prices last year, but we didn't get anything that became like really crazy. We started to had some things that were beginning to approach price targets at like $100 uranium, but we're not going to get $100. We're going to get, if 125 is the long-term equilibrium price, given the inelasticity of demand here and the length of bringing on new supply, you're going to get a couple $100. I think, I don't see how you don't. You're going to definitely overshoot the mark on this. And so, were we starting to see anything near that? Like, no, absolutely not. Were we starting to see like actual equity checks get written or actual projects begin to spend money to get stuff on the ground? Definitely not. So we talk about some of the psychological mile markers that could potentially call an end to the bull market. And we've talked about a couple, and, I don't necessarily share all of them publicly because some of them, might sound silly or whatever, but they tend to work. If we have a situation where utilities are desperate for material and there's going to be issues around actually, keeping these reactors viable unless we can get the next cores into fuel fabrication, which has like a 2-year lead time, by the way. And then you have, a financial player sitting on material. It strikes me like there's a Pareto optimal outcome there, where there's some price well in excess of the spot price, where it would be accretive to the financial player and cheaper for the utility than eventually decommissioning that nuclear reactor, right? So it strikes me like there's a right level there. So if one day, Sput woke up, and I have no reason to think that they'll do this, we speak to them, but this is just completely my own fabrication. If one day, you woke up and Sput sold some, all, of their material, even some, at some big premium to the spot price to a utility to really satiate this emergency panic need to keep a new reactor core going. Would that psychologically, could that call the top? It's possible. I bet all the stocks would rally hugely on that announcement, right? Would that kind of be the top? Something's going to happen. That you never ring the bell at the top, but there are certain indications. And another thing is like there's a few projects out there, some of whom we own, some of whom we don't, that have some very good timelines, or when I say good, aggressive timelines for bringing on their new projects. There's going to be some disappointments because all of these things get pushed out. Do you get a day where there's a project announced that, instead of coming on in such and such a date, it's been pushed out 2 or 3 years, and all of a sudden everything explodes to the upside because there's not going to be as much supply as people think? Psychologically, is that a day? Probably. It'll happen in a period of maximum bullishness and euphoria. Ironically, that makes the tops, right? So it'll be something like that. Yeah, and I think that'll be the end of it. But I think we're a number of years out, and right now, this is, to me anyway. And ultimately, what do I know about some of this stuff? But to me, this feels like some hot money that came in last year that's now consolidating, and that'll set up for a much more robust second leg of the bull market.
That's kind of what I'm finding with it too. And I'm talking to John again soon, by the way, John Chimpaglia, so that'll be a topic of discussion as well. But as far as I understand it, they cannot. I mean, you cannot wake up one morning and Sput has sold some, because they're going to have to consult you as a shareholder as to, do you want to do that? Because
I
technically
have
you're
no idea. That makes sense. Yeah, I don't know.
But anyways, what this reminds me of is basically thinking about, what do I do with this? Like, do I trade around it? And I mean, when it comes down to this, specifically when it comes down to top-down investing, maybe. I mean, knowing all of that theory that you're telling me here and understanding that, that's always interesting to me. But I also often find myself lost in a lot of it, if that makes sense. I'm mostly unable to make micro investment decisions with all the macro background, because it often overwhelms me, Phil. So how do you do it? I mean, what knowing what you know now in terms of uranium, but you can also talk to me about the rest of it. Like, how do you decide the allocation of your portfolio within the sector? Because
Well,
you
look,
mentioned, yeah,
yeah.
go
So
ahead.
I think that ultimately there's not a huge motivation, and the reason I'm being a little bit coy is that you can make the case that you want to own resources stocks throughout the cycle because they're a good diversifier, and that's certainly true. But I think for a lot of people, when it comes down to it, if you don't think a commodity price is going up, if you think it's going to go down, you probably shouldn't own the producers of that commodity. They'll be under pressure and their earnings will deteriorate, and the stock will probably fall. So we look for areas where we think the commodity price needs to go higher, or its path of least resistance is higher. And, ideally it's going to be much higher. And what we look for there, as we talked about before, tends to be the best predictor of that, I think, after doing this for a period of time. It tends to be capital investment and intensity. And in areas where there's not enough capital, what inevitably happens, there's all these other things that play into it. Depletion's super important. Demand trends are super important. But ultimately, the reason depletion is important is they play together. Your assets and your industry begins to deplete and decline over time. So you need to be investing more to go on that treadmill to kind of keep things stable and grow to meet demand. And so the capital side of it is easy to measure. It's probably the easiest to measure. That's why it's so important, right? If you're not investing enough, you're not going to be able to overcome depletion and meet demand growth. And so that's what we look for. And if you can buy companies with good, cheap margins of safety and far below the long-term equilibrium price as we see it, they'll do well. Then we look for names that'll give us exposure to those trends. And so, for instance, there's energy companies out there like Exxon is a perfect example. And what they do is they diversify or they hedge themselves vertically by owning refineries, pipelines, and ultimately even retail. And so they want to stay somewhat immune from changes in the oil price. That's a fine way to run a company. In fact, it's probably, if I had to run a company, that's probably a prudent way to do it. But if our value add is going to be to uncover the research and be able to pick what commodity is going to have a big move, I want to have a name that's going to give me exposure to that. And so I'm
Mm.
looking for names that give me exposure to the trends that we uncover. And that's what's really important. But of course, we talked about out of the money call options or free call options. If all I want is straight upside capture to a trend in a commodity price, I'm going to buy the lousiest company with the worst asset, with the most debt, and hope that the commodity price bails me out. And that's a recipe for disaster. And so every name kind of has that balance between the upside potential and then the risk of impairing the capital. And that's what we try to find the sweet spot for. So it's not the question of marrying the top down with the bottom up. It's not the question of making micro decisions in the face of a macro environment. Rather, the research informs the sector views, which then tells us or gives us a good clue as to where we want to go to get that exposure. Now, we don't always get it right, and sometimes we get it wrong. And like I said, lots of times we're early, and that's where portfolio construction and risk management come in, where we hope that if we get things wrong, we'll be in the penalty box and it'll hurt and performance will suffer, but it won't be catastrophic. And certainly, we've been doing this a long time, and I think the long-term numbers kind of speak for themselves. So, it's not always easy. It's really tough to be the only people saying one thing when everyone else is saying something else. We felt that way with energy a couple years ago. We felt that way with uranium, certainly. And now we feel that way a little bit with gold, where nobody likes gold stocks. Everyone hates gold stocks. And, that's where we're more comfortable. Maybe we're a little bit antisocial. I don't know.
Maybe that's a good way of putting it. I like calling myself a contrarian as opposed to antisocial, but again, to mention my wife two times in one conversation, she doesn't appreciate that too much. You bringing up gold, that's a good segue into what you call a monetary regime change, or what you expect to be, believe, a radical monetary regime change or something of that nature in the not too distant future. How far could that be, though? Is it like a 3 to 5 year thing, or is it a 5 to 10 years thing?
Oh, it could be anything, but I think it's happening right now. And I think, our timeline, our doomsday clock is ticking a little bit closer to midnight on that because I think we're starting to see, major indications that we are moving past a US dollar centric world. And I think there's going to be a lot of huge shifts and ramifications to that. And I should point out that, a lot of people have been calling for the end of the, post Bretton Woods dollar reserve currency for a long time. And all the reasons that they cited have always been kind of valid. It seems as though the US has been, not having its fiscal house in order for some time. And seems as though there's been political gridlock and, people have talked about move from a unipolar to a multipolar world, all these different things, right? You could have leveled all of them in 2009 following the GFC. The difference between then and now is that there was never any indication that people were looking to move beyond the US dollar. So you could say all that is all well and good, but when you looked at commodity trades, they were still 100% denominated in US dollars. When we looked at international bilateral trades, they were all conducted in US dollars. And the cliche example we like to give was that when Australia sold coal to China, it was invoice priced and cleared in US dollars. And that's now beginning to change. And that's a huge difference. It just hasn't been done before. So if you look at, I think it was somebody told me 9% of commodity trades by dollar volume on Swift last year were non-US dollar denominated. Now, presumably, if you really want to stay outside of the US's reach and you really want to kind of stay, a bit clandestine, you're not going to do your non-US dollar denominated commodity trades on Swift. So presumably on some of the other exchange networks that are not part of the Swift system, those numbers are even higher. So it's a mystery as to how much, but we've heard as much as 15, as much as 20%. So who knows? But it's starting to happen. Now, the observation that we made comes from some really interesting work that's completely aside from all this. It's the idea of looking at financial assets relative to real assets, in this case, commodities relative to the Dow. We did this chart going back 130 years. Apparently, or not apparently, we lifted it from Jeffrey Gundlach when we first saw it in one of his double line reports. He, in turn, apparently lifted it from Tony Beck up in Montreal, who used to run BCA Research. And so, whoever started it It's a wonderful chart. It has a huge amount of history in it, and I think it's excellent and really, really intriguing and interesting. But one of the things that we then noticed is that commodities relative to financial assets go through these huge cycles where they become overvalued and undervalued. And first of all, if you buy them when they're undervalued, they represent a pretty good investment going forward. In fact, an excellent investment. But second of all, we started to study it and think more and say, okay, what are some of the trends that are in place leading up to the change? Leading up to the period of radical undervaluation, and then what's the catalyst that takes commodities from super cheap to super expensive relative to financial assets? And by the way, right now we are as cheap as we've ever been relative to financial assets. And the other times were 29, 69, 99, and today. And in every case, every single one without fail, we had a monetary regime change. And I think the reason for that is that when you go through a period where commodities are really cheap, like leading up to the bottom, it gives the central banks more cover to run looser policies for longer without inflation beginning to bubble up. And in fact, in the mid 1920s, we actually in the United States experienced the first instance of quantitative easing when Benjamin Strong looked to print money in a robust economy to devalue the dollar explicitly to help the British pound rise and eventually go back on the gold standard at its pre-World War I rate. And unfortunately, the pound was staying low and it couldn't go back on at the rate. So Strong said, okay, look, we'll print all this money here. We have a good economy. We'll print all this money, devalue the dollar. It'll appreciate the pound, and then you can get back on gold. Ultimately didn't work. Strong died. His opponents immediately contracted the monetary supply after that. And that's how you got the Great Depression. But in the embers of that, you had the end of the classical gold standard and the beginning of what would ultimately post-World War II be Bretton Woods. Following that, 1969, commodities were super cheap relative to financial assets. You had a period of guns and butter in the U.S. where we ran big social programs and big military spending, no inflation in sight because largely, or at least partially, commodity prices were cheap. Eventually, the United States lost its gold backing. We printed so many dollars here, and France in particular started withdrawing gold from the vaults at the Federal Reserve, that eventually by 1968, Johnson said we can no longer honor our requirement to back every dollar by 25 cents of gold, and he abrogated that clause. Nixon closed the gold window in 71 because we actually just ran out of gold or enough to be able to meet redemptions. But it was actually Johnson in 68 that really took the dollar off gold by saying the dollar doesn't have to be on gold anymore. That was the end of Bretton Woods, and that marked almost to the day the bottom of that commodity bear market. And in 1999, that's kind of what Russell Napier calls the no-name revolution. It's less well-known, but basically following the Asian currency crisis in 97, all the Asian currencies, not just China, but led by China, pegged to the dollar at a below market rate to help spur their exports, and they attracted huge amounts of treasury bills as a result, big current account surpluses, which were then recycled into treasuries. And a few years on, you had like $7 trillion of treasuries floating around that part of the world. So we don't call it anything, but it was the biggest shift in monetary policy since the end of Bretton Woods in 68, 71. So we looked at that chart and we said, wow, they all have these really interesting parallels, and I wouldn't be surprised if this major bottom of commodities relative to financial assets also has with it a change in the monetary regime, which of course today is the international dollar reserve currency standard. Don't know what it's going to be, don't know what it's going to look like. Probably will be good for resources the way the other three have been. Probably will be good for gold the way the other three have been. But remains to be seen. So I think what we're looking at right now, the most likely outcome, which again, I don't know what the probability is, but it seems like the most likely, is that China's going to try to move to use the renminbi as a currency for settling commodity trades. But of course, the renminbi is a closed capital account, so you can't repatriate your dollars. If you're selling iron ore or soybeans from Brazil to China, you want reals, you don't want renminbi. And so what China may or may not use would be the Shanghai International Gold Exchange to allow for accumulated renminbi outside of China to be converted for gold and have that gold repatriated back to Brazil and then eventually moved into whatever you want. So is that the end of the US dollar reserve currency status? It's definitely a change, that's for sure. And I would suspect that that's what we're beginning to see now. So I watched that space very closely, and for the first time in 15 years of following these guys, I think we're seeing signs of what they were originally saying begin to happen. You know, the Luke Grommans of the world and stuff like that. So I think it's all happening as we speak.
Hmm. It'll be interesting to see if what the Peter Schiffs of the world have been saying is going to happen too, which would then kind of help me see a little bit of green in my portfolio. But at what point do you think the gold equities go from what you call the most undervalued asset class in the world today to less undervalued, or maybe even potentially fairly valued?
Well, I think it'll be radically overvalued. I mean, things
Okay.
very rarely go from cheapest in the world to fair. They tend to overshoot on both sides. Um, but I mean, you know, I think what's going on with gold stocks right now is that, you know, we've had 2 years of interest rate rises, real interest rate rises. And typically the traditional method of reaction on the part of Western speculators is to sell gold and sell gold stocks when real interest rates rise. That's happened every single time, and that's happening this time as well. So the Western speculator is just puking out gold and gold stocks. Now it's being met by massive central bank gold accumulation. Central banks are buying gold hand over fist. And so if the speculators sold 750 tons, this central banks bought 1,000 tons. That's why gold prices are high. There's been more demand than supply. You've needed price to squeeze it out of other sources. Um, However, on the equity side, it's a different story. Gold equities, speculators in the West are selling gold equities just like they're selling gold bullion. However, the central banks very clearly don't buy gold equities. And so that's why you have gold prices that go up and up and up, and gold stocks that trend down and down and down. And so that's what's creating the huge undervaluation. So, very clearly, in my mind, anyway, what will alleviate the undervaluation is when the Western speculator stops liquidating their gold position and then begins accumulating. Naively, I would say that's when the real rate hike cycle ends. I would suspect that that's when it would be.
Hmm. It'd be very funny if the central banks were actually buying gold stocks and you have Christine Lagarde being my exiting liquidity. That'd be very funny. I don't know for
Yeah.
what reason, but
I don't think. And so what's interesting is that it's not the European central banks, right? The European central banks are not buying it. It is Singapore, China, Russia, India, Brazil, South Africa. You know, Poland bought a lot of gold.
hmm,
It's not the Europeans. And what's funny is that the European central banks made the bottom in 98, 99, right? Britain and then
yeah.
eventually Switzerland made the bottoms. Gold at 275 an ounce. Um, Now they're not buying. And we used to say, oh, central bank's dumbest people in the world, you know, whatever. And now it's like bullish that the central banks are buying. And so Lee and I said, well, how do we reconcile that? And we said, because the Europeans aren't buying it. Once the European central banks buy, that'll be the top of this bull market. They'll buy back their position like at $5,000, $7,000 an ounce, and then it'll all be over.
So
Probably
low and
The
probably high.
Americans too. Yeah.
Yeah, they should get on Reddit. They know how to do that. I don't discriminate though. I'd be happy to sell my stocks to Xi Jinping. That'd be fine too. What does that look like though? I mean, you say radically overvalued. If we look at the GDX reaching a high of about 66 or so in 2011, it's now sitting at over 50% lower at about 30, you can call it. How much does it overshoot? What is radically overvalued for the gold equities?
Oh, I don't know. I mean, people used to, in the last bull market for gold, people used to trade the companies at, first of all, they went from a net present value using a 10% cost of capital. And then they said, let's make it a 0% cost of capital. And that was like the big tagline in the gold investment area for a long time. The argument being, which I never quite understood, that gold is money, and so if all you're doing is taking the money out of the ground, you know, why would I need a cost of capital against that future cash flow? It's there. It's just, you know, it's just going to take some time to be able to transact in it. And the market bought that. And then the market went to trading things at like 2.5 times PV zero.
Hmm.
So radically overvalued. I mean, it's a wild upside potential. You know, the gold on a fair value basis relative to financial assets is probably pushing near $10,000 an ounce. If you just look at how much, gold has represented of the global financial stock over time. If you
Hmm.
take it to a huge, the radical overvalued on gold, then it's like 1.7 times the US monetary base. And you're probably looking at something close to, $15,000 an ounce, with the companies then trading $15,000 an ounce, 2.5 times PV zero. I mean, the numbers get really, really shocking. The upside on gold, the upside on gold has never been the question. It's just been the timing of it. And I think that the timing's getting better, but the upside's there for sure.
I want to put that in the title, and people are going to be pissed at me, but I'm still going to do it. $15,000 an ounce gold. Funny though that I mean it attracts attention, but in a long enough time frame, it could also work.
Well,
Give me
listen,
your
my partner Lee in 1999 with gold at 275 an ounce, having fallen 80% over two
mm,
decades, went on Forbes magazine and said gold 2,500 question mark. And it was completely outlandish, but exactly the same methodology I just laid out for you. Very, very well researched and was right, So, I mean, didn't quite get 2,500, but I think you got to give them the win, near 10 bagger best performing asset class of not just the best next decade, but the next 2 decades. And I think we are now approaching that level of cheapness again. So from 275 to 2,500, from 2,200 to 15,000 sounds conservative.
yeah. Okay, fair point. I'd like to see that. I would like to see it unfold. It it's getting harder to believe it, I suppose, looking at some of the stuff in my portfolio, but um, it is. I um I think it's been fun. It's been most useful. There's a lot of stuff that we could keep talking about, but I definitely appreciate your time. We should do this more often, less than 12 months apart. But what am I forgetting to ask you here at the end? What else should we be talking about?
No, I think that's it. I think we didn't talk too much about oil and natural gas, but both of those markets have just been ratcheting tighter and tighter. And I think particularly U.S. natural gas, which has gone through a second back-to-back really warm winter and seen prices just collapse. You're now completely unsustainable in U.S. natural gas prices, and so we're extremely bullish and excited about that over the next 12 to 36 months. But I think it'll happen quick. So I think that people will, that's an area that people should be focused on.
Well, if people want to read about that again, it's gorosen.com, free reports that they can find on there. But Adam, I appreciate your time, sir. Thank you so much.
Thank you.